A value trap is a situation where a stock is cheap relative to the overall market based on various price metrics, but it fails to deliver even average returns over long periods of time. There are several qualities of a value trap. The driver of it all is a lack of growth. A lack of revenue growth leads to a lack of cash flow growth and earnings growth, which usually translates into stagnant or declining profitability. What do you think happens to the price of a company that has little to no growth? That's right. The price goes nowhere over 5, 10, 20 years or more. And by nowhere, I'm talking about at least doubling your money over a 10-year period. That's only a 7% compounded annual return. Even that trails the S&P 500 average return over the past 20 years by 3% per year. That may not sound like much, but it's huge. It's the difference between growing a $10,000 investment to $20,000 over 10 years versus that same $1,000 growing to $26,000. That $6,000 difference equates to 60% of your original investment. Like I said, the difference is huge. The symptoms of all this lack of growth and poor returns are low price metrics and a high dividend yield, a value investor's dream. And the thing that really gets investors is the fact that they've done well in the past. They've hit a wall, and investors just can't seem to let go of the idea that they could get back to growing like they did in the past. But don't be fooled by these stocks. They look like bargains, but they're crap companies that will set you back in your march towards financial freedom. The first value trap is Pfizer, the pharmaceutical giant. With a 9 PE, 2x sales and book value, a 5% free cash flow yield, and a whopping 6.4% dividend yield. This is a great value, right? But look at the price appreciation. It's down year to date, 1 year, 5 year, and 10 years. It did great in the 80s and 90s, but it's flat since 1998. 26 years later, the price is the same. Of course, you're getting the dividends, and those are compounding over time, but even their dividends are growing at a snail's pace. 4 to 5% over the long term, but that has slowed to 2.5% over the past couple of years, and they cut their dividend in the mid-2000s, so it's no guarantee that the 6.7% yield sticks. And this is all because there is no more growth in the company. Revenues, cash flows, earnings, and profitability are all flat to down over the past 20 years. And this stems directly from the industry they're in. The pharmaceutical industry requires significant amounts of capital for research and development for products that commonly fail to produce any meaningful type of revenue. But even when they develop a product that addresses a health problem and has demand, eventually their patents expire and their profitability of the product erodes over time as generics enter the market and take market share from the original drug. Patent expiration, along with declining adoption over time as people realize and experience the horrible side effects of these products, creates the cyclicality in sales as their revenues spike for a couple of years once they create a new drug, only to fall back to where it was prior to the release of the drug. Even with the COVID vaccine, arguably the biggest public health event over the past 100 years, their sales run rate is already back down to the levels it was prior to the pandemic, a measly 3 years later. There is no sustained growth here like you see with the world's best companies such as Visa and Microsoft, who grow revenues 8, 9, 10% year after year after year with no end in sight. Layer on Pfizer's huge debt load that saps resources from the company and strangles their ability to return profits to shareholders or to reinvest in the company to drive growth. And it's no wonder that even Morningstar, who rates Pfizer as a 5-star stock, characterizes their future outlook as significantly lower revenue guidance than previously expected, stable sales over the next decade, not growing sales, rather stable sales, just like we've seen over the past 26 years. Cost-cutting plans, falling product sales, having to acquire other companies to generate growth. This is not a good sign for a company when you have to acquire other businesses to generate any type of growth. Restructuring to alleviate margin pressures. These are all characteristics of a declining business. And like I mentioned a couple times already, it's been like this for the past 20 plus years. This company is garbage and a value trap at its finest. It belongs nowhere close to your portfolio unless your focus is on the dividend, but even then, the price action is consistently taken away from your returns, thereby blunting the desirability of their large dividend. Next, we have UPS, the world-renowned freight and logistics company that every dividend investor loves. Trading at a 15 PE, 1x sales, and nearly a 4% free cash flow yield with a 4.71% dividend yield, there is some value here. UPS is a better company than Pfizer that we just discussed, but UPS also suffers from a lack of growth which has capped its price appreciation over its entire post-IPO history. Revenues are growing around 5% over the long term, but that hasn't resulted in growth in their company. Cash flows are flat to down over the past 24 years, earnings are up ever so slightly, and margins are trending down over time. All this has led to the price being pretty much flat over the past 5 years and has only increased in price by 26% over the last 10. And it has barely doubled since IPOing in 1999. That's a compounded annual return of 2.5%. Layer on their 4.7% dividend yield, which hasn't always been this high, but for simplicity's sake, we'll assume that it has. This gets you a total return of about 7% per year, which is barely enough to double over a 10-year period. Like I said, UPS is one of the better companies on this list. At least it's showing some sort of growth in price appreciation. But you can do much better with other companies or even investing in an S&P 500 index fund. Our third value trap is Medtronic, ticker MDT. Medtronic is a medical device manufacturer, and this one is particularly putrid. Up 3% this year at a time when the market is up 27%. Up 17% over the past year is respectable, but it's down 23% over 5 years and up only 16% over 10. Revenues are growing around 7% over the long term, but that has stalled to 1 to 2% over the last 5 years. Cash flows and earnings are no better. They looked like a great company in the 90s through around 2010, but they've hit a wall since then. How about the dividends? An okay 5% growth rate that has also slowed to 1 to 2% over the past 5 years. The 10-year rate looks good because of this one large increase in 2015, and they had another one earlier on. But besides that, you're getting minimal growth in the dividend. Definitely not enough for compounding to have a significant effect over a reasonable amount of time. And here's something I don't see from many companies their size these days. You get nothing in terms of share buybacks. With little price appreciation, you get a measly 3% dividend that requires 94% of earnings get paid out to even meet. That's it. And finally, their profitability is in a long-term decline. With a 5, 6, 7% return on invested capital, it's likely that their cost of capital is higher than the return on investment they achieve. This company is destroying value. Operating margins trending down, net margins down over time. This company is possibly the biggest value trap of all time. Our fourth value trap is 3M, ticker MMM. The industrial materials conglomerate has done quite well this year, up 41%, and they're up 60% over the past year. So what's the problem? Well, they're down 9% over the last 5 years and 3% over the past 10 while their business has entered a state of hibernation. Revenues were growing just fine until around 2011, but they've been flat since then. US GDP is by no means a high-flying growth machine. Growing in the 2 to 3% range over the past decade, 3M can't even grow as fast as our over-indebted economy. Cash flow and earnings exhibit the same trend. Paradoxically, 3M looks cheap on a price to earnings and price to sales basis, but overvalued on a cash flow basis. Morningstar also sees them as significantly overvalued, ranking them as a 2 stars with a fair value of $89, which is 32% below where they currently trade. They pay a smaller dividend than other companies on this list, given that they just demolished their dividend by 54% this year. They were considered a dividend aristocrat prior to slashing their dividend. They had not cut their dividend for 64 years. You know things are getting bad in this company when they deem it necessary to cut their dividend after 64 years. This is one of the only times that I've seen a company jump 40% plus in a year where they slash their dividend. The good news is that the dividend should be pretty safe now with only a 46% payout ratio, unless things continue to get worse for 3M given the massive litigation settlements they're dealing with. They have continued to buy back shares at a nice rate of 2 to 2.5% per year, but if they're in a position where they feel they need to demolish their dividend by 54%, it's not unreasonable to be concerned about potential cuts to the share buyback program. Return on capital is in a downward trend, and so are their operating margins. This is a company in contraction. Morningstar mentions declining demand in Europe, the Middle East, and Africa regions, and that many of its mature businesses are nearing or already experiencing secular decline. This is not a stock I would want to invest in. Our final value trap is actually a group of companies rather than just a single company. Commodity and or industrial material producers like producers of iron, gold, copper, nickel, lithium, oil, and gas exhibit the characteristics of value traps. The problem with these types of companies is that the industries they compete in are very capital intensive, very mature, very competitive, and very cyclical. They are highly dependent on global GDP growth, and because the output is pretty much ubiquitous, the companies compete almost entirely on price, which is not something you want from a company you own. Heavy price competition is a sure sign of a lack of a competitive advantage. The symptom of these types of industry dynamics is that revenues, cash flows, earnings, and as a result, the stock price is highly cyclical and goes nowhere over long periods of time. You do get jumps in these metrics from time to time when the price of their commodity increases for a short period, but that appreciation is followed by depreciation of the price of the commodity, and the company metrics and stock price follows shortly thereafter. Many of these companies look like values. They offer low PEs, high cash flow, and dividend yields, but they're traps just like all the other companies that we discussed in this video. Most of the best companies in this space have stock prices that are flat over the past 20 years, and dividend cuts are not uncommon in this space. Even Warren Buffett's baby, Occidental Petroleum, is down nearly 40% over the past 10 years and has only managed to eke out a 180% gain since the 1960s. Revenues are growing 1.5% over the past 10 and just about the same going back to 1985. Cash flows and earnings are volatile and have shown little to no growth. They slashed their dividends in 2020 during the pandemic when the price of oil tanked, but it's been 3 years since then and they've managed to grow the dividend back to 22 cents per share, but that's still down over 75% since the peak of 79 cents per share. Their share count is increasing and has been since at least 1985. And with return on capital down in the 5 to 10% range, or even negative in some years over the past 10, this company is also destroying value for its shareholders. I'm honestly dumbfounded at Buffett's investment into this company. It has very little to offer investors no matter how you slice it. Many of the best oil producers and companies like ExxonMobil, Shell, or Rio Tinto are better companies and investments than Occidental Petroleum. I understand if you want to have a small portion allocated to the commodity sectors for the high dividend yields and the diversification that this sector offers, but I personally stay away. There are so many better options in other industries where dividends are reasonable and growing at much faster rates. Well, that'll do it. I'd love to hear your thoughts on these companies in the comments. Do you agree or disagree? Are there any other value traps that you know of that I didn't cover in this video? If so, feel free to leave them in the comments as well. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in some dividend growth stocks or high quality stocks that could be good buys right now, click one of the thumbnails that you see on your screen right now. Until next time, you all take care. I'll see you in the next one.